Let's move on and talk about fundamentals. Is this weakness in the market justified? Have the fundamentals also weakened in the same proportion or not yet? Harendra Kumar of Elara is joining us now. Harendra, good afternoon. Thank you so much for your time. There clearly seemed to be a very cautious kind of a wave which has gripped the Indian markets. But reality on the Indian economy front may not be as bad. From the fundamental standpoint, how are you looking at the factors at play?
Yeah, thank you, Ajay. So, number one, I think the most guys on the market were actually very circumspect on the rally. So, actually, what you've seen the rally is a doubters rally, and most of them have been left out. So they've been on the sidelines. So be it the banks or be it the PSU banks, I think not many institutional investors have participated in that. So that's one. And the liquidity or the buying ammo of retail investors seems to be waning. So if you ask me, there is no doubt or there is no challenge in terms of fundamentals, but it's only a liquidity event that is underway at the moment, which should actually, in its own way, will recover once people come back from the holiday season. I personally am quite bullish on the liquidity outlook for the next full calendar year plus financial year. One is I expect that the borrowing program of the government in the budget will be a positive surprise, number one. Number two, you will see more traction on the India's inclusion in the bond index. Number three, with inflation tapering, I think the rupee outlook will also improve. So with these three events, I think FII flows will pivot back to India from China, and this could have major tailwinds for the large cap stocks.
Okay, Harinder, also I want to, because you are in touch with your institutional clients on both sides, FIS side as well as DIS side. One fear which is in the market now is that last year the big selling from FIS got absorbed by domestics. Will domestics stand up in the same way to absorb if FI selling continues? Is the fear? Is that a legitimate fear?
Yeah, it is indeed a legitimate fear. So if you analyze the mutual fund flows, you will get around 12 to 15% growth, which is the SIP monies and incremental money that is coming into the industry. But if you have the second leg of FI selling that will come, clearly there will be some damage. And the damage will come where? I think it's more important to analyze where the damage will come. Is it going to be banks, autos, or some other sectors? In my view, the flow of money that came in significantly higher was in the tech index. And there's significant overvaluation in that space even today. So if you analyze the Nifty PE, a lot of the overvaluation in terms of growth and the cost of capital resides in the tech index. So if you see US actually entering recession and the growth numbers for the Indian IT companies actually tapering down, given that they are significantly overowned even now, you could see sharp gashes out there. So yes, one is we have a risk in terms of FI outflows, and within that it flows into a specific sector, which is technology.
Uh, you also started getting positive about domestic economy related sectors. I think quite ahead of everybody else. I remember Harinder. How are you playing the domestic economy related stocks or pockets, capital goods, banks, some other domestic consumption kind of plays? Did they also got a little expensive on the higher side and hence are open to some correction?
No, actually, not. If you break up the top 85% of the Nifty, which is the economy, there are two parts. One which is expensive, which we've just spoke about, which is tech. But if you look at private banks as well, you have HDFC Bank, which is 2.2, SBI, which is closer to book. The private banks are also cheap. You have PSUs, which are cheap. You have automobile stocks, which are at 14, 15 PE. So there's significant value divergence in the Nifty as well. So per se, we're not worried on valuation if you're positioned correctly. Now, two big events are going to happen from this budget. Number one is India's revenue expenditure is going to move slower than its revenue accretion. I think this is a big structural movement, so which gives phenomenal elbow room for the government, phenomenal fiscal space to go out and spend. So if you look at 2 lakh crores as the investing incremental spend that the government will do, let's assume it's all towards infrastructure. with a 5% net profit margin, which means that 10,000 crores of pack to the infrastructure and capital good names, and you give it a multiple of 15 times, there's significant market cap multiple to be added to some of these names. So yes, the incremental story is going to be capex, which moves away from domestic consumption, and also it works the productivity levers in the economy. So corporate profitability to GDP will see incremental uptick from here progressively over the next 3 to 4 years, which will be the key driver. So yes, sectoral allocation becomes a play. Economic construct only will get stronger, not weaker.
What is your, at Elara, what are your overweights and underweights in terms of, if you could talk a little more specifics in terms of model portfolio?
Yeah, so I think banks will have significant headroom for growth even from here. Now, again, within that, your pecking order needs to change, number one. So I think two big events will happen in this year. One is, of course, HDFC Bank's repricing, given the recalibration in terms of the indices, which will probably go off. Second is, the continuation of the capex cycle flowing into credit growth for some of the PSU banks. So some recalibration of the private names and significant overweight on PSUs will work there. Second, of course, automobiles. We've seen selective plays re-rating, but I think the momentum with chip shortage, raw material inflation, and greater consumer spending, automobiles will tend to do well. I think that area where people are missing is energy. We're significantly positive on the power space, be it NTPC, SJV, and NHPC, or for that matter, PFC, REC. The whole energy ecosystem, which we call new energy, is seeing a fresh wave of investments, and there's significant value out there as well. So I think these four areas will significantly beat benchmark indices for the current financial year.
Before I let you go, I know you don't talk levels, but from your rich experience, what's happening right now in the market? We are also catching up with the corrective. Everybody else in the world had corrected quite a lot from the top. We were almost around our all-time high, 2-3%. So maybe some mean reversion is coming. But from current levels, what is the likely scenario for benchmarks? 5% lower from here, 10% lower, or even over 10% kind of fall is not ruled out?
I think every dip should be bought into, be it 5 or 7%, because the risk reward is favorable. The bets are, we have three large events next year. One is, like we mentioned, HDFC Bank. You will have Reliance, which is significantly underowned, and you'll have the reversal of flows, which is more inflows coming into India. So to expect a 20% plus from whatever level we close at maybe in January is not an unreasonable expectation. So even the price behavior, if you see on the Nifty now, is actually a very slow bleed. It's not a sharp capitulation. So that gives us a lot of hope that this very mild liquidity driven event, which will have more upsides than downsides as possibilities.
All right, Harendra, thank you very much for joining us on the show today. That was Harendra Kumar. Always enjoy having our chats.